They've been called financial weapons of mass destruction by no less than Warren Buffett, the famous US investor. Politicians in Europe seem to be obsessed with trying to ban them in some way. They certainly like to criticise them. And every time you hear the word Greece, you'll hear the word CDS not far behind it. So what are they? And actually, should investors worry as much as some people would have them worry? So, credit default swaps. This video is going to look at what they are, who uses them, how they're priced, and what that can tell you about the chances of, say, a country or a company going bust, without worrying too much about the technical details. We'll leave those to the eggheads. So, on this guided tour, we'll be looking at what credit default swaps basically are, what they do, and also rounding up on should investors panic perhaps as much as the politicians. Okay, so let's have a look at one. Let's take a look at this thing called the credit default swap. The best way to think about it is as an insurance policy. Credit default swap, CDS. The title sounds rather grand, but think of it as insurance on investments. So you and I might buy insurance for a car. We pay an upfront premium in return for compensation if something goes wrong. In the investing world, big institutions, rather than you or I, can insure their bond portfolios. What do they want to insure against? The risk that the issuer, the person who sold them the IOU, if you like, goes bust. And that's where CDSs come in. So, typical scenario, you've got an investor. Now, that investor could be an institution, a fund manager of some sort, and they've gone out and they've bought a portfolio of bonds. Now, there are other videos on bond basics, so I won't cover them again here, but do take a look at that other video if you're not sure. But a bond is essentially an IOU issued by a company or a government. And obviously a lot of the Greek media coverage at the moment is talking about what are called sovereign bonds. That's IOUs issued by the Greek government. Why? Because they needed to borrow money. So institutions in the financial markets were prepared to lend them that money by buying up their bonds. So far so good. Okay, so where does a CDS come in? Well, there are two risks with something like a bond, or a share, or any kind of investment really. Number one, it can go down as well as up. There's price risk. CDSs don't do anything about that. However, CDSs, like insurance policies on cars, do something about the catastrophe, the default risk. Okay? Think about it, when you insure a car, the value could go down or up, and you may never need to claim on the policy. The insurance policy is irrelevant to what you sell the car for, in one sense. Same with CDSs. They're designed to protect against some kind of catastrophe. What would that be in the bond market? It would be an issuer, for example, going bust. So, where's the CDS fit in? Basically, let's bring in another player, an investment bank. And basically the nervous investor, the investor who's got these bonds, is thinking, well, I suppose I could dump them all, but realistically who's going to buy them? Besides which, I don't really want to dump all my bonds because they pay an income stream, a coupon, so maybe dumping them wouldn't be that sensible, because what would I replace them with? Cash. And also if I sell my bonds, some of them might even trigger a kind of capital gain of some sort. So really for tax purposes, maybe I want to hang on to them. So as an investor in bonds, you might be sitting there thinking, well, for various reasons, I'm happy to hang on to the bonds, or I may feel I have no choice but hang on to the bonds, and I want some kind of insurance policy. So the credit default swap would work something like this. The investment bank says, right, okay, here's the deal. This is a kind of insurance policy, if you like. So you pay us a premium, which you're not going to get back. Now, the investor's going to be paying this maybe up front, but more typically it's paid sort of in instalments on a kind of pay-as-you-go basis, maybe over, say, 5 years. And in return, we'll offer you some form of protection if, and here's a piece of jargon you see in the press a lot at the moment, there is a credit event. Now, we'll talk more about that, what that might be in just a moment. That is quite a source of debate right now. What are these credit events that could trigger a payout by the investment bank that sold the insurance policy? So in simple terms, a CDS is bought by someone looking for protection against, in this case, bonds, a portfolio of bonds, and sold by an insurer, you'd call it, for cars, but we'll call it an investment bank, someone willing to sell protection. And what is the protection? Well, that can work in several ways. If a credit event takes place, what the investment bank might do is say to the buyer of the insurance policy, I will take all the bonds off you at what's called their nominal value. So I'll sort of guarantee a price for those bonds in effect. And again, nominal value is something I talk about more in my bond basics video, for anyone not sure about that. But in effect, the bank's saying, I'll give you a sort of guaranteed value for those bonds, and you just give me whatever they're worth when the credit event takes place. Now, given that a credit event is some kind of default, it's bad news, chances are they're not worth very much at that point. So it is an insurance policy. Without getting into the technical details, the investment bank is saying we'll pay out if a credit event takes place and take those dodgy bonds off your hands, okay? And we'll compensate you for them. So, like all insurance policies, the issuer would like to just collect the premium and frankly not have to worry. Just go out to lunch. Like your car insurer would like you not to crash your car and just pay a premium, and then they've done something for almost nothing. The investor would probably prefer not to have to claim on the policy, but if a credit event takes place, they may need to. So the next issue, what is a credit event? Well, that's a good question, and there's much debate about this around Greece bonds at the moment, or Greek bonds, Greek sovereign bonds at the moment. Typically, an easy credit event would be a default of some sort. So, for example, one of these bonds suddenly doesn't pay its coupon, or worse, it gets to the redemption date and the issuer simply can't afford to pay it back. So a default, or the issuer just goes bust and all of its bonds become suddenly under threat. So most people would understand that one, but it can get more complicated because credit events can also cover restructuring. And that's where there's a bit of debate at the moment in the Greek market. So for example, if a lot of Greek bondholders are thinking, well, these Greeks are not going to pay us back on time, they just can't afford to, the government can't afford to pay back on time, maybe what we'll agree to do voluntarily as investors is essentially roll over our investment in the dodgy bonds issued by the Greek government into less dodgy bonds issued by the Greek government with some longer maturities and so on. The question that's being debated at the moment, which I don't have an answer to, is would such a restructuring, a voluntary restructuring, constitute a credit event that triggers loads of insurance payments under credit default swaps or not? And that's an issue you'll see debated around Europe just now. Okay, what can credit default swaps tell you about what's going on in the market? And the answer is they can give you quite a good insight into what the market thinks about the chances of, say, an issuer or an entire country going bust. So let's take a quick look at pricing next. Now, the detail of credit default swap pricing is quite technical, but the basic principles are not. First of all, there's one thing you need to know in order to understand the price for CDS and read something into it, which is the market likes basis points. In other words, you get credit default swaps quoted as 50 basis points or 1,000 basis points. You might think, well, what does that mean? I mean, normally an insurance policy is quoted as pounds. Well, basically, you can turn basis points into pounds or dollars more likely, because 1 basis point is 1/100th of 1%. Okay, so on that basis, 100 basis points is 1%, and 50 basis points is 0.5%. So, if someone were to say, right, how much is this credit default swap? The answer might be 50 basis points. And what would that mean? That would give you an indication of the sort of annual fee that the buyer's got to pay the seller, and the way it's expressed is a percentage of the amount of insurance cover, if you like. So what that means is, imagine you take a contract which covers a notional amount of 10 million US dollars of bonds. In other words, it's insurance on $10 million, nominal value as it's called, of bonds. And the price is quoted There's 50 basis points. Basically, the higher this number, the more expensive the insurance is. How does that work out? Well, we said that basically 50 basis points on this basis, the 1 basis point is 100 to 1%, is 0.5%. If you take 0.5% of 10 million, you get 50,000 US dollars. So what we're saying in effect is that CDS is going to cost you $50,000 a year at a price of 50 basis points to provide insurance on 10 million US dollars of bonds. So the higher the basis point quote, the more expensive the insurance. Now, these are figures I just plucked out of the air. So what actually does it cost at the moment to insure Greek debt? Well, to give you an idea, just before Lehman Brothers went bust, the cost of insuring its debt, if you held it and wanted insurance, was around 1,400 basis points. So that's rather a lot higher, okay, than the 50 example I've got here. So that whacks up the premium. All right, if you're still talking about $10 million worth of bonds being insured, a premium of 1,400 basis points would translate into $1.4 million rather than just the 50,000 I mentioned there. What about Greek, Portuguese and Spanish debt right now? Well, let's have a look at some prices. Currently, the cost of insuring Greek debt is in excess of 2,000 basis points. All right, another way of looking at that is you are paying as a premium annually 1/5 of the value of the debt in question. So another way of looking at that is the market is effectively giving the chance of Greeks going bust within 5 years over 80% probability. Another way of looking at that. Who else is the market worried about? Well, that's Greece. Here are some other numbers. 850 basis points. That's Portugal. So again, it's cheaper to insure Portuguese than Greek. Okay, but these numbers have been creeping up the whole time. There is an index that looks at the cost of European debt insurance using CDSs, and it's gradually creeping up and up and up. Look at another couple of countries on the sort of the hit list, if you like. For Spain at the moment, the number's around 300 basis points. And on the sick list, you've got Italy around the 220 mark. Now, what exactly that means in dollar terms is less important than the principle that Greece is obviously well up at the top of the sort of critical list at the moment, followed by Portugal, followed by Spain, followed by Italy. Now, you don't have to agree with the CDS market's view of who's most likely to go bust, but CDS prices can give you a bit of an insight into what the market thinks might happen next. Now, next question. Politicians, and we'll finish on this one. Politicians have been talking about banning speculators, banning CDSs. Warren Buffett called credit derivatives, and these are an example, financial weapons of mass destruction. You know, how much trouble are they? And the answer is, really, politicians are, in one way, using them as an easy scapegoat. They're saying, here's this mysterious instrument with a weird-sounding name that no one fully understands, so we'll blame that. All right, rather than the fact the Greeks might have overborrowed, overspent, and gone bust that way. In other words, politicians will always look for somebody to pin the blame on when actually the blame might lie with them or the people they represent. So, is it right, all these people saying we should ban CDSs? Well, in Greek terms, CDSs are not that important in many ways. Now, the problem with the market is it's difficult to get information. These are private, over-the-counter deals between large institutions. They're kind of shadowy. They're kind of hidden in the wings. So it's quite difficult to get raw, accurate data on how many of these things there are out there, especially when you get into kind of the corporate market for corporate insurance. But nonetheless, the DTCC in the US, the big clearing organisations, had a go, and it said that really the CDS market in Greek terms is quite small. Total outstanding insurance, if you like, on Greek debt via CDS is around 4.8 billion US dollars in a market for Greek bonds, government bonds, worth £500 billion. Okay, so on that basis, you're talking about quite a small market. So would banning it make much difference? And secondly, do speculators really cause the problem? There are some people around who would say that actually if speculators had been allowed to operate more effectively earlier on, if short selling hadn't been banned, for example, effectively speculators could have driven up the cost of Greek debt much quicker. That would have forced the Greek government to rein in spending much earlier, because it couldn't have borrowed on such competitive terms, and that would have forestalled the current crisis. In other words, there might have been a crisis, but it would have happened earlier and it would have been smaller. So far from banning this speculation, if CDSs are indeed purely speculative instruments, we should perhaps have even encouraged it. So if I'm going to criticise the CDS market, it's not going to be for causing the Greek crisis. That's a daft argument. It's not even going to be for exacerbating it particularly. And certainly all this debate about, should a credit event be defined as bonds being rolled over or restructured, that gets a bit technical a bit quickly. Essentially, if these contracts are declared in default, then of course there will be big payouts from one investment bank to another, or from sellers to buyers. But the point is that really to blame the CDS market for what's happening in Europe at the moment is really probably to find a sort of scapegoat. But the problem the CDS market has, and it's its own fault, is it is quite murky, it's quite shadowy, it's been labelled part of these financial weapons of mass destruction. So a little more clarity, the ability for investors to shine a torch into it, would actually now probably help the market and perhaps remove some of the accusations that are flying about what it does and exactly what it's responsible for.